Hello traders, Gary Wagner here. Just after 1 o'clock in Honolulu, 6 o'clock in New York. It is Wednesday, 20th day of November, 2019, and this is the Daily Report for Gold and Silver. Nothing much really moved the precious metals markets today. FOMC minutes were released from last month's meeting. That didn't seem to have any effect. If anything, it seems as though the statements made recently by Fed members had really set the stage for a period of holding. In other words, no more rate cuts this year. The second thing is that in terms of information coming out about the current negotiations between China and the United States, those are nebulous at best and continue to lack any kind of real clarity. Nonetheless, we have seen this market move higher, but in fractional moves, we are long. We'll talk about that as well as our exit strategy today. First, let's take a look at current pricing. We are clearly in the afternoon session. That is the term I use when markets begin to trade overseas, first into Australia, Hong Kong, then London. We are looking at gold currently trading in essence unchanged at $1,474.10. If you recall from yesterday's show, we did trail our stop up. But what I'm finding interesting today is by taking a look at a daily chart. Let's go ahead and pull that up and talk about our upside target. Now, the following model that we're going to look at is based on a longer term Elliott wave count. It shows that we are currently at the end of a wave 4, potentially at the end of a wave 4. We have seen a series of waves fall out of this, and when we look at the timeline, the count really began after a multi-year correction. Market goes from about 1040 up to the first of many attempts to breach 1370. This was a long and protracted correction that came in. This is the bottom or conclusion of wave 2, and then we begin the most robust of any of the impulse waves, which is wave 3. Now, there is a fairly easy way to calculate where wave 5 might go, but to do that, what we have to do is to assume that we have correctly identified the beginning of 5. And on this weekly chart, we can see an A, B, and C. However, I feel fairly confident simply because of the fact that last week we identified the lows coming in at a very logical point for conclusion. Now, there are two basic accepted techniques to forecast a fifth wave. One of those techniques is to take the range that the market traded during wave 1 and do a 1-to-1 extension. What I like to use is to measure wave 3 and then do a 0.618% extension. Now, there are two basic accepted techniques to forecast a fifth wave. One of those techniques is to take the range that the market traded during wave 1 and do a 1-to-1 extension. What I like to use is to measure wave 3 and then do a 0.618% extension. Now, one of the cardinal rules is that wave 3 cannot be the shortest of any of the impulse waves. So while we use 0.618, you could see a 0.78% extension, anything but a larger extension than the net result of the rally in 3. By the way, this third wave produced a rally of about $400. So the 0.618% retracement actually takes us to approximately 1700, 1696. The maximum we could see, and of course this would be a 1-to-1, would take you to 840, so even a 78 or so is 1760. Now, realize that that wouldn't happen overnight. Even if that was to occur, within this last wave, we would see a series of impulse followed by corrective, a third wave impulse, a fourth wave, and then a final fifth wave. If it comes out this way, the key is this. At the point in which we are in a fifth wave scenario, it is highly likely that we will see a result of a rally that is anywhere between $150 to $200 higher than the lows we identified last week. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Maintain your current long, maintain your current stop. Bye-bye.